If you've been looking for a free and easy way to calculate your loan for a new 𝗖𝗍, I've got just the tool for you. But before we begin, a quick disclaimer that this tool provides only an estimate for your most accurate loan amount. You still need to obtain an IPA from a banker. So for the first step, click the link in the description to grab a copy of your Excel calculator. And when you open the file, you'll notice a number of tabs, and because I'm always improving on this tool, by the time you watch this video and open the file, it could look very different. So let's start with the first tab, and here I'm going to use the data of a fictional couple and some fictional income information to demonstrate how you can use this tool to calculate your own loan for a new 𝗖𝗍. I'm going to key in the names of my fictional couple here, and that's James and Wendy. And I'm going to assume that they are both 35 years young. And because we're doing the calculation for a new 𝗖𝗍, and at this point in time, the income ceiling is still kept at $16,000, I'm going to assume $8,000 of income for the both of them, along with $8,000 of fixed bonus and also $8,000 of variable bonus. And if you're a self-employed individual, you can key in your annual income as per your IRA statement in this field instead. Next, I'm going to key in some information on their financial liabilities, beginning with the number of credit cards that they own. I'm going to assume 2 credit cards for both of them and a monthly car loan of about $700 under James. For this next portion, you can key in any other loans you are servicing, for example, any personal loans or student loans, etc. However, if you're currently a second timer and you own a HDB and you are servicing a monthly HDB loan, you actually don't have to key in your monthly HDB monthly payment, because if you're buying a new 𝗖𝗍, you eventually have to sell away your HDB, and so your HDB loan will eventually be discharged. So even if you're paying a monthly HDB mortgage, you can key in a 0 here. I'm going to key in 0 for both James and Wendy. And for this Excel, I've generally kept it simple. You only need to key in the fields that are marked in yellow. However, for the next section, there is one field to bring your attention to, and that is the interest rate safety factor. This is a value used by the bankers as a safety buffer to calculate the borrower's max loan eligibility, and it may actually differ from bank to bank. So this is why it's important to always check back with your banker. Here I'm using 4.5% as the safety factor to calculate, but you are free to change this value to anything else that you may think is more appropriate. And so the next segment will provide us the loan estimate for James and Wendy if they were to purchase a new 𝗖𝗍, and their loan tenure is at 30 years with a maximum loan amount of $1.08 million. And assuming an interest rate of 4%, their monthly payment will be $5,163, but this will only come in at the end of the normal progressive payment cycle, and that's at the very last stage, CSC, which I will talk about in a while. But here at this juncture, I thought it would be useful to go through 2 questions that I've been getting quite often from clients who might be quite new to this whole process of financial calculations. The first concept being that whilst it is true that the loan support is at a maximum of 75% of the purchase price, the actual loan that you'll be able to get depends on your own age and income. So for example, in this case for James and Wendy, given their age and income, their max loan for a new 𝗖𝗍 is at $1.08 million. So if they were to purchase a new 𝗖𝗍 unit priced at $1.5 million, 75% of that is $1.125 million. However, their loan won't be at $1.125 million, it will be at $1.08 million, which is their own max loan amount, and any shortfall from that loan amount to $1.5 billion, they will have to top it up in a combination of cash and CPF. The second concept I want to go through is the difference in loan when buying a new 𝗖𝗍 versus when you're buying a resale 𝗖𝗍 or a condo. This Excel tool also provides an estimate if James and Wendy were to buy a condo or a resale 𝗖𝗍. And if you notice, this loan is much higher at $1.8 million. And the reason for this difference is that buyers of a new 𝗖𝗍 come under this framework called the mortgage servicing ratio, which stipulates that buyers who are buying a new 𝗖𝗍 and also a HDB for that matter can only use a maximum of 30% of their monthly income to service a mortgage loan. However, for those buying a condo or a resale 𝗖𝗍, meaning those 𝗖𝗍s that have already met the MOP, their loan comes under the total debt servicing ratio. And this framework allows buyers to use up to 55% of their monthly income to service all of their debt obligations. And that includes their car loans, their personal loans, also including their mortgage loan. So I've included this portion for this Excel tool because for buyers who are assessing the affordability options for a new EC, you may find that purchasing a resale EC or a new condo might actually be more affordable because your loan is higher. So at least that's an additional option for you to consider. The next thing to cover is how to calculate your buyer's stamp duty, which all buyers will have to pay regardless of their residential status. The good thing about purchasing a new EC is that even if you own a HDB at the current moment, if you purchase a new EC, you will not incur the additional buyer's stamp duty. So with effect from 15th of February 2023, the buyer's stamp duty rates have been further segregated into a few different tiers depending on your purchase price. And so for James and Wendy who are purchasing a $1.5 million unit, you can use either of these two, 4% less $15,400 or the next tier, and you'll find that both use the same answer. Their buyer's stamp duty is $44,000 and $600. Next, I'm going to cover how does your mortgage payment look like under the normal progressive scheme. And just to be clear, the purpose of this video is to only help you cover some broad concepts concerning the mortgage loan. It's not so much to go into the specifics of a financial breakdown involving your CPF and cash on hand, because there will be a much longer video than this video needs to be. I'll probably do a more detailed financial breakdown in a separate video, but just to keep this illustration simple, I'm going to put the financial figures for James and Wendy aside and assume that for a purchase price of $1.5 million, this particular set of buyers were able to take the maximum 75% loan, and this is what their progressive payment schedule will look like. So the sequence of payment will always be cash followed by CPF followed by loan. The progressive payment schedule works in such a way that each tranche of payment that is being called is in conjunction with the completion of the project depending on which stage that it's at. So in this flow, at the foundation stage, when the developer has called for a 10% payment, half of that will be paid for by the bank loan, and that's an amount of $75,000, and the corresponding mortgage payment to you as a buyer is $358. So essentially, you're only paying the mortgage loan on whatever amount the bank has paid out for you. And as the payment stages progress and the bank pays out progressively more loan for you, your monthly mortgage payment will increase from $358 to $1,074, $1,432, and so on until the final stage at CSC, where your full mortgage loan will kick in at $5,370. Do note that for projects like this called BUCs, building under construction, your interest rates will always be at floating rates, which means that the actual mortgage payments, as illustrated in this table, will depend on the prevailing floating interest rates at that point in time when you begin your mortgage payments. And the last portion I'd like to go through is the mortgage schedule tab, which gives you an idea of how much interest and principal you're paying every single month. So here I'm going to use the loan amount for James and Wendy at $1.08 million over a loan term of 30 years, assuming an interest rate of 4%. At the CSC stage, they'll be paying the full monthly payment of $5,156, again depending on the prevailing interest at that point in time. And here you can review how much is the proportion between the interest and principal per every single monthly payment. And so because mortgage loan works on an amortization formula, the interest levied is always on the remaining unpaid principal. So if you notice, the interest is always higher at the start and it decreases along with every subsequent payment. So I hope that was useful. I'm keeping this video short, and I know I didn't go through in detail what happens after you get your mortgage loan estimate, because it also involves other things like your CPF on hand and your cash. And if you're a second timer, what happens after you sell your HDB and you get your sales proceeds back? Because that will make this video way longer than it needs to be, and I'll probably cover some of these in a separate video. If you need any help to put some of these financial figures together for your own financial breakdown, I'll be most happy to speak with you. And if there's any topic you'd like to see a video on, drop it in the comments below. Take care, and I'll see you in the next one.